We need to turn our thinking inside out because people say, well, it's too expensive to buy it here. And that's absolutely not the case because this is the beginning of it. We're in the second or third inning of this. People have a very difficult time with that. What people want to do, though, is they immediately want to psychologically get the self-gratification. In fact, Druckenmiller tells that very story in this interview. It's a great story about NVIDIA. He'd made a huge gain on it, and he's a big trend trader.
Yep.
And he goes, it was like at $800. NVIDIA was at $800. And so he sold a big part of his position. And he was so proud of himself. He tells the story. He's so humble. I love the guy. And within a few weeks, it was at 1,500. He's been in the business forever. And it was painful,
Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today, we're sitting down with educator and Wyckoff expert, Bruce Fraser. I met Bruce a number of years ago at a conference, pretty sure it was down in New Orleans, actually, and we hit it off as we were walking to dinner, and it has led me to a number of fantastic conversations with Bruce over the years. He is just genuinely one of the most warm and approachable and thoughtful market practitioners that I have ever had the chance to overlap with. Today, we're going to unpack sort of the idea of Wyckoff analysis. We'll talk a little bit about Richard Wyckoff and his methodology. We'll talk about how we can use the labeling practice that Wyckoff pioneered to define the structure of the market and how the current market environment fits actually very nicely into the structures that Wyckoff created and popularized many, many decades ago. All along the way, you're going to hear some pretty awesome quotes about market analysis and decision-making. And some great market insights as well. So please enjoy this conversation with educator and Wyckoff expert, Bruce Fraser. I am super excited to be sitting down with the person who I would argue one of just the nicest people in the industry that I've ever met, Bruce Fraser. Bruce has been in the industry for about 45 years. He spent 30 plus years as an educator, teaching technical analysis, teaching the Wyckoff Method, which he still does to this day. I've learned a ton, and I would say some of my favorite experiences, Bruce, of attending a number of conferences over the years is on that off chance that you and I sit near each other during dinner because I know we're going to laugh a ton and enjoy it. So it's great to see you here today. Welcome.
Thank you, David. When you invited me to come on, I was so excited. I love to hang with David. It's fun. If we can't sit at dinner, we'll do this.
Yes, that's right. Standing invitation that we'll get together at some point, Bruce. But for now, this will have to do for all the viewers and the listeners. So Wonderful. Listen, as I mentioned before we got started, we do a market recap show, and often I will get comments and questions from viewers mentioning the Wyckoff method, that this is a certain Wyckoff pattern or season or setup. So I know that a number of the people that follow my work understand at least something enough about Wyckoff to know that it's something they probably want to know more about. So I hope we can help kind of set the groundwork for some of those people and especially those that aren't familiar to kind of know what they'd be getting into if you start looking at things through a, we call a Wyckoffian lens, I guess. For people unfamiliar with what the Wyckoff method is or Wyckoff in general, how would you explain just the core idea or premise of that in plain English for people that are unfamiliar?
David, why don't you ask me an easy question?
And you have 5 seconds.
Wyckoff is visual. It's very visual, but it's very contextual. And there's a reason for everything that happens in a price chart in the Wyckoff method. And this method goes back to Richard D. Wyckoff, whose career spanned from the late 19th century through his death in 1934. And he wrote a course. It was a correspondence course, which was how things got done in that era. And he wrote it when he was recovering from illness, and it's brilliant work. And the thing about Wyckoff is the Wyckoff wanted to be able to explain everything that was going on the chart. And so there's reasons for everything that happens. There's the reasons why you get big markdowns, climactic conclusions to those markdowns, and then you build a cause, which may be a cause for another markdown, or it might be a cause of accumulation. And the thing that we would always do in the class, and Hank and I taught this class for 27 years, is that you're always dealing with the narrative of the different informed interests that are in the market. And so we characterize them, and they're heuristics. There's the public, who are the weak holders of stocks. And then there's the institutions, and then there's the composite operator, we would call them, which were the very best institution. Typically they're institutions, but they're the very, very best. They are the way out on the edge of the distribution curve. And there's a lot of institutions that are just, kind of in the middle of the curve. It's where they want to be. And there's some that are just exceptional. And they're not all technicians. You look at somebody like Warren Buffett, who very clearly is a composite operator. Obviously, as we all know, he's way out there on the curve. But what we're doing is we are telling the story of the smart money, the composite operator types, through the action of these structures that are occurring, because stock needs to be in strong hands to go up. There's the essence of it, is that stock needs to be accumulated, absorbed in strong hands. And these strong hands are very knowledgeable. They know what they're doing. They know why they're doing it. For instance, one of my favorite CO types is Stanley Druckenmiller. And he just did a really good interview with Morgan Stanley. And it's on YouTube and you can watch it, but listen to how he talks about, say, buying NVIDIA. He's a very chart-centric visual person, and he's a trader-centric person, but he has all the skill sets. And so we find those people and we evaluate them and we try to build their abilities and belief systems into our own nature. So in Wyckoff, and we did a lot of this in San Francisco, is we literally set up groups where we learned how to be able to study the behaviors of the best investors of the era. And so, for instance, we studied the market wizards, and we would get the market wizards to come out and talk to us, and so on. And we would model their mindsets. So I'm always interested in that, but that's a very Wyckoffian thing, because what we're doing is that we're modeling the mindset of these CO types. We're watching their behavior on the charts. We're watching it in the relationships of spread and volume from one bar to the next to the next. And this is what we would teach. And then we'd put it all together in the context of the whole structure. Now, it sounds a little esoteric here, but it happens this way over and over and over. So I've written a number of blogs on this. We use schematics. And these schematics, no two charts are alike. No two setups are completely alike, but they have family resemblance. And you can see, right? You can see the characteristics of the weak holders, which are literally just giving up their stock into the final lows of the market. And the support on the chart is set by the large informed interests that have decided. Support, by definition in Wyckoff, is the value zone. This is the place where the large interests have said, this is where I want to start to accumulate this position. And there's a saying on Wall Street, and we don't try to buy the lowest price, believe me, but it tells you a lot about the way COs think. Because what do we know about COs? You know a lot of COs, David. Mm-hmm. I should be picking your brain. Why the hell are you interviewing me? And so these are the people, they know what they're buying, they know why they're buying it, and they have such a big portfolio that it takes them a long time to do it. Think about how long it takes a Warren Buffett to be able to build a meaningful position in a stock that he wants to own.
Yeah.
And when he builds that position, the only thing that's going to get him to sell that position, and this is the part about absorption, accumulation absorption, is that the only thing that's going to get these big, large, informed holders to give up their position is much higher prices.
Mm.
And that could take years, right? This is one of Wyckoff's laws, which is the law of supply and demand. So when there's a huge amount of supply out there and stock's not in strong hands, prices are going to fall. There's no support for that stock. There's no sponsorship for it, and down it goes. But it's going to get to a price zone sometimes, not all stocks do this, where it becomes very valuable at a price, because this is an auction market. These people step in, they start accumulating shares, and when the supply gets all absorbed through the course of that accumulation structure, then the only thing that could happen is the tiniest incremental increase in demand, supply and demand. Supply gets absorbed, tiny increase in demand, that stock is going to start marking up easily, right? And it's not going to take a lot of volume to do it. I don't think there's anybody that explains volume better than Wyckoff.
There's so many awesome points that you hit in there and a number of great quotes. I scrambled to write down as many as I could, but stocks need to be in strong hands to go up. That's my new favorite quote. I love that one. That's a good one. No two charts are alike, but they have a family resemblance. That's a keeper too. We'll keep both of those. It's so funny. You mentioned, the larger institutions and how long it takes them to accumulate and distribute, right, positions. And that, in my experience working for large money managers, it was really fun to have a lot of zeros in a fund you're working with, but it also was the most restrictive, painful thing because you were the Titanic just slowly kind of nudging one way or the other.
Right? I mean, great institutions trade the way they do because they have to.
Yeah. Oh, yeah. We spend most of our time dealing with the constraints of the size of the funds and less enjoying the great benefits of the size. It was more painful than anything in my experience, right?
Your experience and your knowledge about that is priceless.
You're kind to say that. You're kind to say that.
Well, it's true. It's very true.
So tell me this. And so one of the things that I've learned having, listened to you and Roman Bogomazov, who I know you've worked with closely for a number of years at Wyckoff Analytics. When I hear either of you present, I'm always struck by the labels that you assign. When you bring up a chart, it's labeling a markup phase, these different periods. And can you talk a little bit about those labels? You mentioned a number of them during different periods. Why is that labeling so meaningful? And is it something that I guess ties it to this larger structure, this way that, different charts have a family resemblance?
Everything in the Wyckoff world is contextual. Everything follows an order. If there is stocks in weak hands and it's on its way to going to strong hands, there's certain things that have to take place in that stock for that to happen. We're like trackers, and being trackers, we're out there, we're following the herd. We can see where they're going. We know what their tendencies are. This is the same thing with a CO. The CO is so big that they can't hide their tracks, but they do everything they can to muddle them up. They don't want anybody to know what they're doing because lesser institutions will start to compete with them for available shares of stock supply that they're trying to absorb. They don't want any competition, and they don't care about the public. What they care about are other institutions. So when you complete, now this is a long way. I'm sorry I'm going around the block to get there, but when you think about the context of an accumulation structure, we look at it as phases, and we basically start with phase A, which is the stopping of a downtrend. Phase B is stock is still in weak hands, but there's a floor under the stock, which is established by the composite operators. That is their definition of the value zone. So they're going to be willing to buy stock along that value zone, and they are very patient about waiting for that. So they will wait and they will buy stock at the bottom. And in the olden days, I don't know about now, but in the olden days, they would supply the market with some stock to check the advance and keep it in a trading range. because if there's still a lot of supply, you still have lesser institutions in the public that wants to get rid of their stock. And interestingly, when you get all the way through the basing structure, so you have phase A, which is stopping the decline. Phase B is building a cause, which is this big volatile trading range where support is evident, but also supply comes in at the top of the range. And then you have the final phase C, which is the final testing phase of accumulation. That is where most of the absorptions occurred. And it's the beginning. Phase C is the beginning, the last test in the beginning of markup, but it's still in the trading range. And phase D is the markup to the top of the trading range. Phase E is the new uptrend once you get out. And you can see that every phase has a different price volume characteristic. But here's the part that I find so interesting, David, is that the public, when you get to the ending of the accumulation, they become so worn out by the stock not going anywhere that they may have bought it at the top and held it all the way down. And the last of them, and it may be the public, it may be institutions, but they finally just go, I can't stand it anymore. I got to get out of this thing. I can tell you countless stories about people giving up their stock as phase C goes to phase D and the new uptrend's about to begin. And so it's every aspect of this is very psychological.
And that gets me to, I think, what I would argue is one of the best parts of the Wyckoff method. I love that, this cause effect sort of relationship that you've mentioned a number of times makes a ton of sense. The idea that there's these different phases and thinking of technical indicators as a way of kind of categorizing where we're at within this larger structure. Can you talk a little bit more about the behavioral and psychological implications of the Wyckoff method? Because I think that, for me, the podcast is called Market Misbehavior, and that was an intentional choice of recognizing the fact that so many investors just make bonehead mistakes and make it's poor decision-making more than anything. What are kind of the behavioral or psychological implications of a Wyckoff structure? And if you could extend that analogy, what does it tell you about the current market environment with so many kind of growth-oriented stocks feeling very extended? How does that fit into this structure as well?
Sure. And think back to Druckenmiller's great interview, which I so encourage people to watch it. But he says, contrary opinion is really overweighted. It's like, once you get into a trend, the majority is right. Once you come out of the accumulation structure and you start marking up, that's where all the fun is. I find the accumulation structures interesting. And there's a whole other aspect of accumulation and distribution. And we have another sub area called reaccumulation, which is these pauses on the way up. And redistribution, which are the pauses on the way down. Those are very valuable. And those have a lot of the characteristics we just talked about, phases, and so on. But the thing about accumulation when it turns to markup is that for most traders, it's very psychological that they have a really hard time paying for strength. And this is one of the things that we psychologically really work on in Wyckoff is that, a stock that was at $30 at the support level, and then it gets out of the trading range and it's at 60. It's like, well, I can't buy it now. And, with Wyckoff, because we were looking at the context of the situation we're going, this thing just moved very easily up and out of a resistance area that's been in place for a year and a half. And it did it. And now it doesn't even want to pull back. It just goes, if it stops out of the accumulation area, it just goes sideways. And it's just it starts to really leap. And in Wyckoff, we need to turn our thinking inside out because people say, well, it's too expensive to buy it here. And that's absolutely not the case because this is the beginning of it. We're in the second or third inning of this. People have a very difficult time with that. And so you read a book like Reminiscences, which is, arguably about Jesse Livermore. And it really is about, there's just some great stories in there about paying up for stock to prove itself coming out of these big resistance areas and started to really mark up. And he would say things like, I got a terrible fill on that trade, which showed that I was absolutely right. It's like he took this horrible fill that he got as confirmation that the stock is in strong hands and it's difficult to buy and to own. And so as soon as people start to get a little bit of a profit, they want to sell their positions.
Yeah.
The trend is absolutely where all the opportunity is. Wyckoff, it establishes that, it's like, hey, this should be a really good trend. Now, maybe some of them don't work out. Certainly I've had my fair share, but once you got a tiger by the tail, you just don't let go. And what people want to do though, is they immediately want to psychologically get the self-gratification. In fact, Druckenmiller tells that very story in this interview. It's a great story about NVIDIA. He's like, he'd made a huge gain on it. And he's a big trend trader.
Yep.
And he goes, it was like at $800. NVIDIA was at $800. And so he sold a big part of his position. And he was so proud of himself. He tells the story. He's so humble. I love the guy. And he goes, within a few weeks, there was at 1,500. He's been in the business forever. And it was painful,
I was going to say, there's nothing more painful than that Druckenmiller story you just mentioned, right? Selling and feeling great for just a brief moment and then watching, on the sidelines as the gains just continue to compound.
Yeah.
What, with the number of the examples that you're talking about, I'm curious how you would describe the time frame upon which the Wyckoff framework, the Wyckoff method is best applied. When you're analyzing charts and applying a Wyckoffian framework, are they daily charts you're looking at? Are they weekly charts? Are there certain periods of time where a certain phase would need to take, or is it more just about the supply and demand dynamics?
Such a good question, because Wyckoff is very fractal. My personal preference is I like to look at daily and weekly timeframes.
Mm-hmm.
So it's like, I really do try to be in sync with the composite operator mindset and try to, identify them and follow them. That's all we want to do, is we just want to follow them. We don't want to get ahead of them. This is a business about being in the moment. In my world, I'm always telling myself this, and I say it all the time: reasons are optional. It's just the charts talk to me. They tell me what I think they're saying is what's going on, and then I act on that. I don't know one widget from another. So I just follow that. But daily, weekly time frame, I'll look at monthly time frames. I'm looking for big causes, really big causes are really intriguing, difficult to trade because they take so long to build. And I've written about some of them in my blog posts. But also it's very fractal. You can look at the intraday time frame and you can see all the characteristics of accumulation, because it happens in every time frame. There's CO types in the short-term time horizons. And you don't know that these CO types who are building, they have these great trading desks. I'm sure that, many of these people, and you could tell many stories. These people are very, very good at what they do at accumulating these shares, and their behaviors, what they're doing will show up on the intraday timeframes.
Interesting. Yeah. So it really does have that fractal nature. And it reminds me like Elliott Wave, right? Elliott and others have talked about that same kind of fractal nature to some of those patterns. I'm curious. So if Richard Wyckoff was alive today and looking at a chart of the SOX, right, the Semiconductor Index, would he describe that as one of those we're grabbing the tiger by the tail, we just don't want to let it go kind of situations? Or how would you describe? Because I know that's a trade that for many feels like we've missed it. How does that, what would that structure look like as just an example of how we'd apply it in a current situation?
I was just going through many of those stocks yesterday, and the reaccumulation structures that have formed in the last few months in many of these semiconductor stocks are textbook. That and so reaccumulation, and I write a lot about that. And as a matter of fact, we're working on putting all those posts together and turning it into a book. So this is a current project that's going on, and but you can just go and read them right on stock charts, so you can see how a reaccumulation structure will start, you can see the hinging action, you can see the absorption characteristics, and you can see that stock is being bought. And typically reaccumulations take less time. And part of the reason they take less time is because the stock is already deeply in strong hands. So what they're doing is it's like a mopping up action. It's like the trader types will, sell stock and they'll cause a temporary pause in the market, and the strong hands will come in and absorb those shares. Now, having said that, you can have a final upthrusting action and it can result in a distributional structure. But patience is an amazingly important thing in our line of work. And right. And so distribution is a process that takes time.
Yeah.
And, typically you can't have a big move without a cause.
Mm.
And so in the case of, say, the semiconductors, when they conclude, because they are in such strong hands, that the large holders that hold these stocks that have had beautiful campaigns in them will need time to distribute their stock. And that is what creates a distributional structure. So distribution occurs. There's some very distinct differences between distribution and accumulation. But on the schematics, which you can see on my blogs, they look like mirror images of each other. Okay, accumulation, distribution. But there's very distinct differences in how they unfold, the phases. So we say there's 5 phases of distribution. You stop the advance. Then you see the first sign of supply, large supply present. That tells you that this is the place where the CO is going to start selling stock. That buying climax tells you this is the point. This is the opposite of the value zone. This is the sell zone. And so the stock may climb above temporarily that buying climax area, but you just draw a horizontal line across the top of that buying climax, and there's your resistance zone. And the stock will just stay, might pop above it. It'll come right back in, and you draw support under what we call the automatic reaction, which is that huge supply dump that occurs after the buying climax, which is temporary. And then now you have the boundaries of where the distribution is going to take place. And the CO is going to do everything they can to keep the stock in that zone until they've sold out their entire position and maybe are short. We can see it. We can see the phases, A, B, C, D, E. We can see the phases and the characteristics, and we know the characteristics of how price and volume will relate to each other.
I so appreciate you talking through that, Bruce. Puts the semiconductor move into context, but I appreciate you talking about the signs of distribution. And I would echo what you said. Your blog at stockcharts.com is very well written, and I would encourage people to follow your work there, because you shared generously with examples illustrating some of these points, which I think would help. I know you also do a lot of work with Roman at Wyckoff Analytics. Can you talk about the education you guys are trying to do there?
Well, Roman was one of our students in the 90s. Hank and I had him in a class, and you would come across people that just have true burning desire. They have true passion. And Roman was one of those people right then and there. And he's gone on to become, probably the premier educator in the Wyckoff Method in the world today. It's like, I was an educator. I did it for a long time. I love doing it. But he just continues to just offer these great advanced classes in this material. Me, I'm more of a doer now. I like just trading the markets, and hanging out with David and cool people like David. So that's the fun for me. And, but I do a webinar every week with Roman where we talk about current market conditions, and it's on Wednesday afternoons. It's called the Wyckoff Market Discussion. And we just completed our 500th episode.
Wow. That's a milestone. That's impressive.
10 years.
Wow.
So, Yeah.
That's awesome. That's at
So,
wyckoffanalytics.com. We'll make sure we include a link to that, Bruce, so
oh,
people can
lovely.
check it
Yeah.
out.
It's
I'd
called
encourage you to do that. So one other thing I would say to wrap up, a final question. I think one of the great joys we get to do is celebrate some of those technical analysts and market practitioners that have passed on. You mentioned Hank a number of times, the great Hank Pruden. Tell us, for those that did not have the opportunity to work with Hank, who was Hank and how did he kind of shape your journey as an investor?
oh, he was just everything to me. And he just became, he was my mentor. He was just we were very close, and I couldn't spell chart, when I was in graduate school, and I took his class, and he was such a brilliant educator that by the second class, I'm like, I'm going to do this the rest of my life. I love this stuff. He was great because he taught me so much about Wyckoff, but he taught me a lot about the industry and about academia. And, he cleaned me up and made me presentable. And, and so
All order there for Hank
it's
Pruden.
been very tall order. And so anyway, God bless him, but he was the greatest educator I've ever known. And we had so much fun. We worked on a lot of projects together. One of these times we'll get together and we'll talk about a group that we did on peak performance called the Zims Group. And we had the market wizards involved. We had Van Tharp involved. We had turbine traders, and we started this group, and it was incredible. And some of the stuff that we did, I don't know if you can see this. There we go.
Yeah, the
Three skills of
top
trading.
trading. I remember that book.
This book he wrote it later on, and some of what we did in the Zims Group is in that book, and about a third of the book at least is Wyckoff.
Yep. Yeah.
And it really is about creating the whole trader, peak performance, methodology, and so on.
Hank was one of the good guys, and I would say for those of us that spent a lot of our career on the East Coast, you should know there's a huge technical analysis community in the West Coast, and Hank I think of as a giant of that community. He taught the course at Golden Gate University for a number of years, and I know you were involved with and many others that went through that program based in San Francisco. And I've heard nothing but great experiences from people that did that. So that thanks for sharing some words about Hank.
That was a whole story in itself because everybody wanted to come to Golden Gate.
Yeah.
Like all the greats would come and they wanted to be in the city, hang out with us, lecture. There's no better community than the technical analysis community. And they're so generous and such wonderful people. And we would get them all. We had it was a who's who list of great people that came through Golden Gate. And I was so blessed, and I didn't even know it. You're one of them. You came through many times.
I enjoyed it greatly for sure.
Yeah.
Bruce, this is awesome. As always, a great combination of some very quotable moments. And I really appreciate you sharing some thoughts about the Wyckoff Method. Following you and your work has really helped me to understand and appreciate the structured approach to thinking about supply and demand. So we definitely encourage people to check out your blog at Stock Charts. We'll include links to your work with Roman at Wyckoff Analytics, and we'll include links to some of these books we've talked about too, because I think they're fantastic reads.
Thank you so much, David. And I'll leave you just with this.
Yeah.
Is that Roman put a course, it's a pretty complete course, together on the foundations of Wyckoff Method. And we did this a number of years ago, but it's really good. People really love it. And he's got it on sale right now for $50.
Oh, wow.
And so, feel free to go check that out. And if it looks interesting, that might be a great way to get a sort of a foundational understanding of the Wyckoff Method.
We'll include that link as well, Bruce. Hey, listen, great to see you. I hope we could do it again. In the meantime, thanks for coming on the show today.
David, thank you. So good to see you.
Thanks again to Bruce Fraser coming on the show today. Bruce is awesome, and I love his celebration of the contributions of Hank Pruden. Hank was one of the good guys. Bruce and Hank worked together for many, many years. He shared Hank's book, and we'll have a link to Hank Pruden's fantastic book, which I read years ago and just absolutely loved. I had an opportunity to overlap with Hank a bit, not nearly as much as Bruce did, but would echo his comments that he was just a genuinely thoughtful and giving and generous educator, and ignited a passion for technical analysis and market analysis in so many investors along the way through his work at Golden Gate, and also through organizations like the TSAA based in San Francisco and the CMT Association as well. There's so many awesome quotes in there. Reasons are optional, right? I love that comment that, is a sort of a pure technical analysis view, right? The idea is you're looking at the structure of the market through this Wyckoffian lens. So the reasons why these patterns are emerging as, sort of described by that Wyckoff framework, the reasons don't really matter. The point is that we are matching the structure, which tells you there's accumulation or distribution, tells you there's this interplay between cause and effect, or supply and demand, a lot of the things that I think Bruce spoke to. A stock needs to be in strong hands to go up, right? If you heard it, he mentioned a number of times the CO, the composite operator, sort of the smart money, right? The people that know more than others and have assets to move around. I like that idea of the strong hands sort of, creating these uptrends and really continuing these uptrends a lot longer than a lot of people would imagine. No two charts are alike, but they have a family resemblance. What a great way of talking about another, sort of parallel to that. History doesn't repeat itself, but often rhymes. One thing I found, having worked with a lot of technical analysts over the years, is that the experiences that you have as an investor, as an analyst, sort of help you recognize pictures, right? And help you recognize a certain configuration, right? So when you see a certain configuration with the price and indicators and volume and whatever it is that you're looking at, it just sort of clicks. And you could probably articulate, here's why these factors, mean this is bullish or bearish or whatever. But at the end, it's more just, I've seen this kind of chart so many times, I kind of have a pretty good idea what's going to come next. I'm probably going to position myself for that next likely outcome. Once you get a tiger by the tail, you just don't let go. Talk about a way to describe these extended uptrends that we're experiencing in areas like semiconductors, recognizing that strength can go much higher. And as he pointed out, and I would agree, there's nothing worse than selling for a profit, but then sitting there on the sidelines as the price of whatever it is continues to go higher. So one of the great benefits of a trend follower is it's really hard to sell early because your job is just to follow the trend as long as possible. And so long-term, low volatility uptrends a lot of times can be so fantastic. Bruce has done some great work with Roman Bogomazov at Wyckoff Analytics. We'll include a link there also to Bruce's Stock Charts blog. And I'll tell you, if you liked what he shared today, definitely follow his work on the Stock Charts blog, because he shares a lot of great example charts, a lot of visuals that will help sort of fill out some of the conversations that we talked about, digging into themes like cause and effect, supply and demand, and the composite operator. Great rundown, great intro to Wyckoff investing, and thanks again, Bruce, for coming on the show. By the way, if you want to learn more about how you can make better decisions using the best practices of technical analysis, analyzing trend, momentum, and volume, and all these different inputs that can help us visually represent the interplay between supply and demand, you may want to check out our Market Misbehavior premium memberships. This is a way for you to upgrade your decision-making, to learn all about technical analysis and behavioral finance, have someone mentoring and accounting, keeping you accountable all along the way. 3 great benefits to the premium membership. First off, we will teach you all about technical analysis and behavioral finance through our virtual courses. We will keep you informed and inspired and aware through our member-only reports like our weekly flight plan and our monthly chart review. You will have full and immediate access to our member community where you can ask questions anytime, where you can learn from other like-minded investors and move your own decision-making process onward and ever upward. You can learn more information about our premium memberships at marketmisbehavior.com/premium, and I hope you'll check it out and become a premium member today. That'll do it for today's episode of the Market Misbehavior podcast. My name's Dave Keller with Market Misbehavior, reminding you it is always a good time to own good charts. Take care, folks.